We will now turn our attention to mortgage underwriting. Underwriting in general means the due diligence a lender conducts to ensure that a potential borrower is able to repay the loan, or in short, to evaluate lending risk and to decide whether or not to make a loan. Mortgage underwriting processes differ between residential and commercial loans. We will start out with a focus on residential loans. Before we move on with residential underwriting, let's go over a couple of important loan types. As I mentioned earlier, non-conventional loans are those loans that are insured by the Federal Housing Administration, or called FHA loans, and those that are guaranteed by the Department of Veterans Affairs, or called VA loans. All other loans are called conventional loans. Typically, when a borrower puts less than 20% of the property value down, the lender requires that the loan is insured by a fee or premium. There are two types of insured loans: loans that are insured by the FHA and loans that are insured by private mortgage insurance. Those are called PMI loans. Conforming loans are loans that follow Fannie and Freddie guidelines or lending standards. These loans are sometimes referred to by the professionals in the industry as plain vanilla loans and are considered the safest of all loans and therefore also charge the lowest interest rates. A loan that is not conforming is the jumbo loan, which is a loan that has a loan amount higher than a specific hurdle amount. The guidelines for the hurdle amount change over time and are different for different geographic areas. In Pinellas County, for example, in 2019, the minimum loan amount for a conventional jumbo loan was $484,350. In other words, a loan over $484,350 is considered a jumbo loan. Since jumbo loans are non-conforming, they are typically more expensive. Generally speaking, all else equal, a higher loan amount is considered more risky and therefore typically demands a higher interest rate than a conforming loan. Other important loan types are the fixed rate loan and the adjustable rate mortgage, or ARM. As the name states, the fixed rate loan is a loan for which the rate stays fixed throughout the life of the loan. However, for an adjustable rate mortgage, or ARM, the rate gets adjusted once per year. ARMs have typically initial time frames during which the rate stays fixed. For example, a 5-1 ARM is a loan for which the rate stays fixed for the first 5 years and then adjusts to an interest index once per year. There are loan types that were very popular during the real estate boom between 2003 and 2006, but are considered very risky and pretty much disappeared after the mortgage crisis. The Dodd-Frank Act required that banks, which are federally insured, make sure that they issue safe loans and make loans which borrowers can afford. Federally insured means that the money that is deposited with the lending institution is insured by the federal government. The loans that disappeared after the mortgage crisis were not allowed to be made by a federally insured institution, where the so-called option arm, or also called negative amortization arm. Regular arms are not as risky. It is the option arms that are very risky. In an option arm, the borrower has a choice or option of paying at least temporarily an interest rate that is lower than the loan's actual interest rate. The result is that the difference between the interest payment for the loan's actual interest rate and the lower payment the borrower chooses to make gets added on to the outstanding loan amount. That is why this type of loan is also called a negative amortization loan. For these loans, the loan balance can increase over time and the borrower ends up owing more and more, potentially even more than the property is worth. As you can see, this is a very risky situation for the bank. No income verification loans, or also called stated income or liar loans, are loans for which the borrowers do not have to verify or prove their income. They only state their income. Oftentimes, borrowers overstate their income or lie about their income in order to get financing and end up with loans which they really can't afford. Again, this is a very risky situation for the lender. No-income verification loans were very popular with people like waiters and valets during the real estate boom. Waiters and valets do not typically show very much income on their tax returns as they receive much of their income in cash, which they often don't report. Waiters and valets therefore cannot prove but only state their income. Without these types of loans, it has become very difficult for people who do not report a lot of their income to get funding. The last risky loan type was a zero down payment loan. As the name states, the borrower does not have to pay any money down when getting this type of loan. As the borrower has no skin in the game, the borrower can be very motivated to default and walk away from the loan, which makes it a very risky loan. Before we go into the detail of the underwriting guidelines for residential and commercial loans, let's first take a look at some mortgage statistics. The amount of money that has been borrowed in the U.S. for mortgages was steadily increasing since the 1980s up until 2008. Then, due to the mortgage crisis, the amount dropped, but has seen a rebound in recent years. The amount is quite staggering. For example, in 2000, the mortgage debt outstanding in the U.S. was $6.6 trillion. That number increased to $9.3 trillion by 2003. That is a 50% increase in just 3 years. That amount reached its height around the beginning of the mortgage crisis in 2008 of about $14 trillion. By the end of 2012, mortgage debt decreased to about $13 trillion. It is not a surprise that mortgage debt outstanding decreased during the mortgage crisis, as some of the outstanding loans were foreclosed on and disappeared. As of 2018, the mortgage markets have recovered and the debt outstanding was at over $15 trillion, which is above the pre-crisis level. In this chart, you can see what percent of mortgage debt is secured by the different types of properties. What clearly stands out in this chart is that the largest percentage, about 70% of all mortgage debt outstanding in the U.S., is secured by 1 to 4 unit single-family residences. The second largest percentage is 18.62% for commercial properties. This means that 18.62% of mortgage debt in the U.S. is backed by commercial properties. You can see in this chart the percentage of mortgage debt that is held by different entities in 2018. The holders are grouped into depository institutions, life insurance companies, federal and related agencies, mortgage pools and trusts, and individuals and others. The largest percentages are 35.38% for federal and related agencies, which includes the Federal Reserve Bank and Fannie Mae and Freddie Mac, and 31.91% of depository institutions, which includes commercial banks, savings institutions, and other lenders. Those two numbers together make up almost 70% of all U.S. mortgage debt. It is no surprise that federal and related agencies hold such a large amount of mortgage debt, since the Federal Reserve had bought up hundreds of billions of dollars of debt instruments, including mortgage-backed securities, as part of its monetary policy in the years following the mortgage crisis in order to keep interest rates low. Mortgages can be originated by different organizations, which are called, as you know by now, mortgage originators. Loans can be originated by mortgage bankers, for example. These are banks that borrow money from commercial banks, originate loans, and then sell them to the secondary market. Mortgage banks may continue to hold and service the loans or sell them to investors in the secondary market. The term mortgage lenders is a general term that means an entity that lends money to borrowers who buy real estate. This would include mortgage banks, credit unions, and life insurance companies. A correspondent lender is a lender that funds a loan in its own name and then always sells them off to investors. A corresponding lender is almost like a hybrid between a traditional lender and a mortgage broker. Correspondent lenders can lend their own money or money from a line of credit, but they can also shop a mortgage around to other lenders, like a broker does. Whether the correspondent lender funds the mortgage directly or shops it out to another lender, it will usually handle loan approval with its own in-house underwriters. This can mean a faster approval process for the borrower. Commercial banks are institutions that accept deposits and then either loan or invest the funds. Commercial banks make loans for all kinds of purposes such as cars, houses, and businesses. Savings institutions, which are also called savings and loans or S&Ls, are banks that specialize in real estate financing. They accept deposits and then lend money to the buyers of houses. The last big U.S. banking crisis in the 1980s and 90s involved these types of banks. In fact, the crisis was called the S&L crisis. During the S&L crisis, 747 out of the 3,234 savings and loan associations in the U.S. failed because they either made bad loans and or incurred losses due to rising interest rates. Their cash outflow increased when interest rates they had to pay to depositors skyrocketed to over 16%, where their income from interest on fixed-rate loans stayed the same, below that level. Credit unions also originate loans. These are like commercial banks, but to be a customer of a credit union, you have to become a member of a specific industry or community. For example, USF has its own credit union. The credit union profits are returned to members, so they are like non-profit organizations. The advantage of a credit union is that it offers cheaper services such as low fees and interest rates. Mortgage brokers also originate loans. I want to focus a little more on the mortgage brokers next. Mortgage brokers are the middleman between the lender and the mortgage applicant. Before the mortgage crisis and before the Dodd-Frank Act, licensing requirements for mortgage brokers were very lax. Only few states required licenses, and their continuing education requirements were negligible and very easy to fulfill. All you had to do is buy a book and show the receipt to get your continuing education credit. However, the new mortgage regulations after the mortgage crisis now require that all mortgage brokers, just like all mortgage originators, have to have a mortgage loan originator license. The new regulations require that all companies, branches, and individuals who originate mortgages have a unique nationwide mortgage licensing system and registry, or NMLS identifier number. This NMLS ID is supposed to improve the supervision and transparency in the residential mortgage markets by providing regulators, the industry, and the public with a tool that tracks companies and individuals across state lines and over time. This in turn is supposed to cut down on mortgage fraud and unethical lending practices. Since the mortgage crisis, some of the large banks, for example, Wells Fargo and Bank of America, have announced they were no longer working with independent mortgage brokers. These banks feel more comfortable and safer when they only originate their own loans in-house. This, together with the new licensing laws and the fact that fewer people borrowed money during the economic crisis, caused a decline in the number of mortgage brokers. The National Association of Mortgage Brokers reports that it had roughly 5,000 mortgage brokerage and lender business members in 2013, down from 25,000 in 2006. In 2019, however, with a rebound in the real estate and mortgage markets, that number was over 39,000. The mortgage brokers' share of home loans also dropped as their numbers declined. In an article by the trade publication Inside Mortgage Finance, I read that during 2011 and 12, mortgage brokers accounted for about 10% of all mortgage originations, compared to more than 30% between 2004 and 2006. This chart was given to me back in 2005 by a mortgage broker. This shows that at the time, the states in dark blue color had no licensing requirements at all for individuals working in the mortgage industry. Now, all real estate brokers have to have a license and a national ID so that they can be tracked. We are now ready to move on to the residential underwriting requirements and the uniform residential loan application process. Most lenders, especially those that are insured by the FDIC Federal Insurance Program, use the standardized loan application form. It complies with the requirements imposed on lenders by Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac require these forms from everyone who gets a loan, which might end up in the hands of these government-sponsored enterprises or GSEs. The application collects information about a borrower's income, employment history, other debts, other assets, net worth statement, rental history, and so on. The lender will want copies of all documents that are used to evaluate lending risk. Should you ever go through a mortgage application process, keep in mind that the process of collecting the necessary documents can be very extensive and time-consuming.